Welcome to G Fun Facts Online. Imagine a world built on numbers, where every transaction, every profit, every loss tells a story. But what happens when that story is a lie? What happens when billions of dollars simply vanish from a company's books, or when profits appear out of thin air? When the integrity of our financial world is threatened, a special kind of investigator emerges from the shadows. They aren't police detectives, but they hunt for criminals. They are the unseen guardians of financial integrity, forensic auditors. Today, we're diving deep into their world to see how they uncover the biggest corporate crimes in history. Think of a regular company audit as a general health checkup. It's routine, designed to make sure the financial statements look generally healthy and follow the rules. A forensic audit, however, is like calling in a specialist for a critical, life-threatening illness. It's not routine. It's triggered by suspicion, an alarm bell that something is deeply wrong. The goal isn't just to check the books, but to find evidence of fraud, misconduct, or financial crime that can stand up in a court of law. So what triggers these high-stakes investigations? Often, it starts with a whistleblower's tip, an anonymous letter, or a glaring discrepancy found during a routine check. Maybe a company is involved in a bitter legal dispute, and one partner accuses the other of hiding assets. Or perhaps a company goes bankrupt, and creditors want to know if fraud was the cause of its collapse. Forensic auditors are trained to spot the red flags of financial misconduct, and these clues fall into three main categories. First, there are the financial red flags. These are the most direct signs. Think of a sudden, massive drop in cash flow without any clear business reason, or a huge number of transactions with a single, mysterious vendor. A classic red flag is when a company's reported revenue soars, but the actual cash coming into its bank account doesn't increase. That suggests the sales might be fake. Missing documents like invoices or contracts are another huge warning sign. Then, there are the behavioral red flags. The actions of people can be just as telling as the numbers. Is there an employee living a lavish lifestyle that their salary can't possibly support? Are they strangely reluctant to take a vacation, perhaps because they can't risk someone else looking at their work? A high turnover rate in the finance department can also be an indicator that something is wrong, a sign of a toxic or high-pressure environment where fraud might thrive. Finally, there are organizational red flags. A company culture dominated by a single, all-powerful executive can lead to a dangerous lack of oversight, or an environment that puts immense pressure on employees to meet unrealistic financial targets can push people to cheat just to keep their jobs. Complex corporate structures with countless shell companies can be a deliberate strategy to hide debt and deceive investors, as we'll see in some famous cases. Once the suspicion is raised, the hunt begins. The forensic audit process is methodical and precise. The first stage is planning. The auditors meet with the client to understand the suspected fraud, who might be involved, and what the investigation needs to achieve. They map out their strategy, defining the time period and the scope of their search. The second stage is the heart of the investigation, evidence collection. This isn't just about looking at spreadsheets. Forensic auditors use specialized software to recover and analyze data from computers and servers, sifting through emails, text messages, and even deleted files. Every piece of digital evidence has to be handled with a strict chain of custody, documenting its every move to ensure it's admissible in court. They also conduct specialized interviews designed to elicit truthful information and spot inconsistencies in stories. The third stage is data analysis. With potentially millions of transactions to examine, auditors use powerful data analytics tools. One fascinating technique is called Benford's Law. It's a mathematical principle that states, in many real-life sets of numbers, the first digit is more likely to be a 1 than a 9. Data that has been fabricated often doesn't follow this natural pattern. By applying Benford's Law, an auditor can instantly spot datasets that look suspicious and might have been manipulated. They trace the flow of money through complex webs of bank accounts and shell companies to see where stolen assets have gone. Finally, the fourth stage is reporting. The auditor prepares a detailed report that outlines exactly what they found, how the fraud was committed, who was involved, and how much money was lost. This document becomes the foundation for legal action. If the case goes to court, the forensic auditor may take the stand as an expert witness tasked with explaining complex financial schemes to a judge and jury. Let's look at how this plays out in the real world. The collapse of Enron in 2001 is the textbook case of corporate fraud. The energy giant seemed incredibly profitable, but it was a house of cards. Forensic accountants were instrumental in untangling the mess. They discovered that Enron used thousands of off-balance sheet entities called special purpose entities to hide billions of dollars in debt and inflate its earnings. The investigation revealed a systematic, complex deception that ultimately led to the company's downfall and the passage of the Sarbanes-Oxley Act, a law that fundamentally changed corporate governance in America. Then there was WorldCom, another scandal from the early 2000s. The company fraudulently inflated its assets by a mind-boggling $11 billion. Their method was deceptively simple. They took normal operating expenses, like the costs of running their network, and recorded them as long-term capital investments. This simple accounting trick made the company look far more profitable than it was. The fraud was uncovered by a small team of internal auditors who, working in secret and often at night, pieced together the evidence of the massive deception. Their forensic work led to CEO Bernie Ebbers being sentenced to 25 years in prison. And this isn't just a problem of the past. The 2020 collapse of the German payment processor Wirecard is a modern cautionary tale. The fintech darling admitted that 1.9 billion euros in cash that was supposed to be in trust accounts likely never existed. Forensic investigations are still uncovering a complex web of fake business operations and collusion designed to fool investors and regulators for years. These cases show the critical role forensic auditors play as financial detectives. To succeed in this field, you need more than just strong accounting skills. You need an investigative mindset, a healthy dose of professional skepticism, and an obsessive attention to detail. You need to be a critical thinker who can analyze complex data, and a clear communicator who can explain it to anyone. Many professionals in this field earn the Certified Fraud Examiner, or CFE, credential, a global standard that proves their expertise in financial transactions, law, and investigation. The world of financial crime is constantly evolving. Today's forensic auditors face challenges from the increasing sophistication of fraud schemes, the sheer volume of big data, and the rise of cryptocurrencies, which provide new ways for criminals to launder money. But technology is also providing powerful new tools. Artificial intelligence and machine learning are being used to analyze data and predict where fraud is most likely to occur. As criminals get smarter, so too must the guardians of financial integrity. Forensic auditors are the detectives of the financial world, piecing together puzzles of corporate deceit and ensuring that, in the end, the numbers don't lie. They are the quiet heroes who work to maintain trust in our economic systems, one investigation at a time.